Markets are on fire. The S&P 500 just printed new all-time highs. Gold is breaking out. Crypto's heating up again. We've had 10 straight days of upside with barely any pullback. And my market monitor, a proprietary gauge of the market internals, is locked on green. Today I'll show you what this means for stocks, gold, and crypto, where I see opportunity, and the signals that tell us when the fire might be finally about to cool. Quick note, this video is for educational and informational purposes only, and it is not financial advice. Always do your own research before investing. The S&P 500, ticker symbol SPY, is the headline story. It pushed to new all-time highs today, tacking on about 0.5 intraday, Monday, September 15th. And it's done it with remarkable persistence. We've now logged 10 consecutive up sessions, with every small dip being almost bought instantly. So technically, the S&P 500 broke out above the early September highs with strong follow-through. Volume isn't explosive, which is typically in a grind higher, but breadth continues to widen. The price action since April lows has formed a clean wave pattern that could stretch towards 140 trading days, matching some of the longest cyclical advances of the last decade. The NASDAQ 100, ticker symbol QQQ, has been just as impressive. It lagged briefly earlier in the month, but staged a sharp breakout last week and is now up 9 sessions in a row. The pattern resembles a Wyckoff Spring style setup, a sudden shakeout followed by a relentless march higher. Small caps, as measured by the Russell 2000, ticker symbol IWM, remain the outlier. They rallied but still lagged large caps this week, a reminder that risk appetite isn't universal. This divergence could resolve with some small cap catch-up or a mild pause in the big indexes. My proprietary market monitor acts like a market filter for the internal market health, breadth, momentum, and liquidity. Right now it's firmly green, and we're on day 8 of this green cycle. Historically, a green cycle lasts about 12 to 13 sessions and delivers, on average, a gain of 3 to 4%. So far, we're only up roughly 2.7%, which means there's statistically room to run. A deeper dive into some internals. The put-call ratio is down around 0.55% on Friday, reflecting strong risk appetite. The VIX sits near 14, well below long-term averages of about 18. And we've seen 80 individual stocks gain 20% in 5 trading days, a sign of broad speculative energy. Some stage analysis and breadth readings confirm the momentum, but signal some weakness coming soon. Stage 1, stocks that are basing, are about 6% of stocks. Stage 2, uptrends, are about 59%. Stage 3, kind of topping basing patterns, are about 10%. And stage 4, declining stocks, are about 25%. That's a healthy mix. It's a strong participation, but yet not extreme enough to force an immediate reversal. Still, the sheer persistence, 10 straight days and 9 straight days on the QQQ, means we should watch for a short-term climactic feel as we approach the Fed meeting this week. While equities grab headlines, gold quietly stole the show last week. It broke out on heavy volume with no bearish candle structure to speak of. This type of strength often signals expectations for a softer dollar or lower real yields. Classic fuel for gold. Technically, gold cleared a major resistance band and is holding those gains strongly. If the dollar stays range-bound, or we maybe get any dovish surprises from the Fed this week, that breakout could extend towards the next measured move targets. Crypto's waking up again. Bitcoin reclaimed its prior breakout range after spending about 11 days below it, a constructive sign. However, it remains the weakest of the major assets. It hasn't printed a new high in months, and even on strong equity days, it's been relatively subdued. Ethereum mirrors that choppy structure. It's still above key moving averages, but hasn't managed a decisive springboard move. It did hold on to critical support below that big candle, which keeps the bullish case alive. But for now, crypto is more of a slow burn than a raging fire. So as we head into Fed week, here's some signals on my radar. We've been rallying a lot. It's a very strong market. rallying into this news event. If the Fed ends up being less dovish than the market hopes, it could be a sell the news event. The market monitor cycle count, we're on day 8. Once we get past day 12 to 13, probabilities of a short-term pause rise. So the put-call ratio and the VIX are extremely low readings and mark a sentiment peak if it can stay compressed. And gold follow-through, a strong close above last week's breakout would confirm another new leg. And then crypto volume, it needs a little bit heavier buying to validate the range reclaim because it's kind of getting it back today. So right now, the message from my indicators is really clear. The primary trend is bullish. Breadth and momentum remain strong. Gold provides a non-equity hedge that's breaking higher. And crypto is a watchlist item, constructive, but it's not leading anymore. So for traders, that means respecting the uptrend while managing risk. And for investors, it argues for staying allocated and avoiding the temptation to fight the strength just because the tape feels hot. Markets are on fire, but every fire eventually cools. I'll keep tracking the internals every day and update you guys if we see early signs of exhaustion. If you found this breakdown helpful, tap that like button and subscribe so you don't miss the midweek top stock setups video and Friday's 100K portfolio update video. Hey, drop a comment below which asset you guys think leads this week, stocks, golds, or crypto. I read every comment and often they spark ideas for future videos. And thanks again for watching, and I'll see you guys on Wednesday. Cheers.